All right, let's jump right in. When you think about a big business loan, you probably imagine all the risk is up front, right? In the underwriting, the intense negotiations, that final signature. But what if I told you the real danger, the thing that can absolutely sink a deal, is actually a quiet process that happens years after the ink is dry? Today, we're going to talk about debt covenants, not as some dry legal terms, but as the absolute last line of defense against what's known as silent deal failure.
So let me just ask you this to get us started. When does a business loan really fail? Is it the moment a borrower misses a payment, or maybe during a big market crash? Well, the real answer might actually surprise you.
Here's the uncomfortable truth. Most loans don't just blow up spectacularly at the beginning. They corrode. They fall apart quietly, bit by bit, right in the middle of their life, long after the deal team has high-fived and moved on to the next thing. And that, right there, is where our story really begins. And this brings us to a really critical idea, the silent failure window. Think of it as this danger zone, usually a couple of years into the loan, where that intense front office scrutiny just fades. It's not a top priority anymore, it's become a routine, back office task. And it's precisely in this quiet period that the seeds of failure really start to grow.
So, if we want to prevent this, we have to completely rethink what monitoring actually is. Because believe me, it is not just about ticking boxes on some spreadsheet. Let's bust a few of those common myths.
The myth is that monitoring is just some simple administrative chore, right? Just checking ratios after the quarter ends. But those are lagging indicators. They only tell you about a problem that has already happened. The reality? True monitoring is active surveillance. It's a strategic defense, constantly on the hunt for the leading indicators, the little clues of trouble on the horizon.
And that leads to the key thing any good system has to detect: covenant drift. Now, this isn't some sudden, dramatic breach of contract. No, it's a slow, quiet erosion of a company's financial health. It's that subtle warning sign that things are heading in the wrong direction long before any official alarms go off. Catching this drift early? That is the entire game.
So how do you actually do it? Well, effective surveillance really has three distinct layers. First, of course, you've got the financial covenants, the hard numbers like your debt service coverage ratios. Second, you have the non-financial covenants, basically the rules of the road for what a company can and can't do, like taking on more debt. But that third layer, that's the crucial one, the behavioral indicators. These are the subtle clues, things like a sudden delay in reporting that can tell you way more than any spreadsheet ever could.
Okay, so now that we know what good monitoring is supposed to look like, let's flip that on its head. Let's do an anatomy of a failure and see exactly how deals break down when that active surveillance just isn't there. It usually comes down to three classic weak spots. First, you've got the reporting lag, which creates this dangerous information gap. Second, there's the temporary waiver trap, which can slowly undermine the entire loan structure. And third, you have what happens when monitoring gets pushed too far down the chain of command.
Let's talk about that reporting lag for a second. When a company's financials arrive late, it's so easy to just shrug and say, oh, it's just an administrative slip-up. But seasoned lenders know better. It is often a delay tactic. It's a way for a borrower to buy time, maybe to massage the numbers or to hide a growing problem. By the time you get the data, it's already old news.
And what about waivers? This is a big one. When a borrower has a minor breach, the easiest thing to do is just grant a temporary waiver to keep the relationship smooth. But here's the trap. Those temporary waivers can quickly become permanent crutches. If you grant one without getting something in return, like more visibility or tighter controls, you're basically signaling that the rules don't really matter, and you're just inviting them to push the boundaries even further next time.
And look, these aren't just theoretical risks. Let's look at three quick, real-world examples of how these failures actually play out. You'll see the very real cost of getting complacent. So take the EBITDA add-back illusion. Imagine a company is struggling. To meet its covenants, it starts adding back so-called one-off costs to its earnings. Now, a passive monitoring system, it just looks at the final number and says, okay, we're good. But an active system digs deeper and asks, wait a minute, why are these one-off costs happening every single quarter? The covenant is technically being met, but the company is actually falling apart underneath the surface.
All right, so we've spent a lot of time diagnosing the problem. Now let's pivot to the solution. How do you actually build a defense that can stand up to these silent attacks? What does a truly robust monitoring framework look like?
There's an old industry saying that just perfectly captures the idea here. Underwriting defines the risk, monitoring manages the outcome.
Think about that. You can have the most brilliant, ironclad loan agreement in the world, but if nobody is actively enforcing the terms, it's basically the same as having no rules at all. At the end of the day, strong monitoring is a discipline. That means you have to independently validate the borrower's data. You can't just take it at face value. You need to set crystal clear triggers for action. You have to focus on real cash flow, not just accounting tricks. And you must have a strict, disciplined process for escalating issues when they come up. There can be absolutely no ambiguity. And here's a fantastic, practical example of a clear trigger. Let's say your hard covenant is a 1.50x coverage ratio. Don't wait for it to get breached. Set an internal soft trigger at a higher level, something like 1.65x. When performance dips below that, it's not a crisis. Not yet. But it is an early warning. It gives you the chance to have a quiet word and step in while you still have all the leverage.
Now, I want to be clear, this isn't just some timeless lesson in risk management. The need for this kind of intense monitoring has become incredibly urgent because of the massive shifts we've all seen in the global economy.
Just look at this simple chart. It tells the whole story. For years, low interest rates meant debt service payments were pretty manageable. But now, with rates so much higher, that exact same amount of debt creates a much, much larger payment. It's dramatically eating into that financial cushion, that headroom that companies used to have.
And that pressure is being compounded by a couple of other huge factors. First, refinancing a loan today is way harder and more expensive. Second, with company valuations down, the equity cushion that used to protect the debt is a lot thinner. That margin for error that pretty much everyone took for granted for years, it has simply vanished.
So what does all this demand? It's simple. A fundamental mindset shift. Monitoring can no longer be seen as some back-office cost center you have to deal with. In today's environment, it is a front-office defense mechanism. It's the system that protects your capital and preserves value.
And this really brings us to the core message, the one thing to take away from all of this. Deals don't fail because covenants exist. Covenants exist to prevent failure. Deals fail when those covenants start screaming that there's a problem and nobody acts on that information.
So, I'll leave you with this final thought. If you think about debt covenant monitoring as the immune system of a credit portfolio, the thing that's supposed to detect threats before they become fatal, the final question we all have to ask ourselves is this: how confident are you that yours is actually working?